Hey y'all, welcome to the Dividend Nomad. Over here, we talk about high yield dividend investing so we can live anywhere we want to live in the world. Right now, I'm living here in China, but to be clear, I'm not living off my dividends yet. I'm working on that right now. I'm working on towards that goal, but I share my journey here with y'all. And today, we're going to be talking about how to get $2,000 per month from your portfolio so we can live off of that. And why did I choose $2,000? Because I've been living here in China for 14 years and I've traveled all over Asia. And there are so many places in Asia that you can live a really great, comfortable life on $2,000. For example, Vietnam, Thailand, Philippines, Indonesia, Malaysia, Laos, Cambodia, even here in China. I spend about $1,200 a month living here in China. So many places you can live a really great normal middle class lifestyle, not a luxury lifestyle, but you can live a great normal middle class lifestyle, and in some cases can even do some nice, like more luxurious style things and nice apartments and things like that. You can get all these things for $2,000 a month or less here in Asia, with the exception of a few places like Singapore or like Shanghai or Beijing or something like that, right? Or in Hong Kong as well. But other places, it's highly doable. So that's why we're focusing on $2,000. So let's get into this. I did some research for y'all. Let's have a look. And at the very end of this video, I'll share a little secret information that I found out that I think you will find very helpful. So let's dive in here and I'll show you some of these. So these right here are some more traditional ones that have been around for quite a while and a lot of people have been using is this type of vehicle. So the first one you can see is QYLD. We have JEPI and JEPQ. So these have been around for a little bit. The QYLD has been around for a long time, more than 10 years, I believe. And for this one, right, in order to generate $24,000 per year or $2,000 per month, at the current price right now, if you went all in today, you would need 11,215 shares, and that's going to cost you just over $200,000. So if you went in right now today with $200,000, you'll have enough money to have $2,000 per month in passive income. Now, one thing I want to show y'all here, I know QILD's strategy is a little bit outdated because they don't have this super massive yield like the new high yielding stocks, which we're going to talk about those here in just a minute. But let me dive in here on my phone, and I just want to show y'all a little something really fast. So let me open up my app, and let me find this Defiance. I got some, oh, here we go, Global X, QYLD. So if we look at the chart of QYLD, let's just check this out, and we'll put it on the max time frame. Okay, so on the max time frame on the QYLD chart, you can see the chart is going up, right? The price has risen, it's fell, it's risen, but overall, as long as you didn't touch it and you just took your dividends out and didn't sell any of the stock, you would have an increase in capital. So let me go back and have a look at this here. Let's check out the fund performance. You can see over the 10-year time frame, it's a 4-star rated fund. And if we scroll down and check out the performance, look, 1 year, 17%. 3 years, what? 13. 5 years, 41. 10 years, 111%. So as long as you don't touch this and don't sell it, you will appreciate in capital and you will get all these dividends out and your money's not going to wither away. So is this a good fund to use for this purpose? I believe it is. But you need $200,000 right now to pull it off with this fund. Now, if we look at the next one, you have JEPI, JEPI. This has been around for about 3 or 4 years, I believe. So it's got a pretty decent track record. This one, it pays more money, but it's more expensive. So as you can see here, in order to get our $2,000 per month, we're going to need $313,000 today. If you were to buy it today at the current price, you need $313,000. So it's a little bit more expensive than QIOD. But this one also if we look at the chart on this one, I'll just show y'all really quick. I'm not going to show you all of these on the chart. We'll just look at it really quick though. If we go to, let's see here, these are some of my income ETFs, JEPI. Let's look at the chart on this one. So look at this one on the max time frame. Again, you can see the chart is moving in an upward direction. So your capital's not going to erode. You're not going to lose the money you put in as long as you hold it over time and don't sell it. And if we check the fund performance here, you can see, look, all green. There's no red here. So since inception, 61%. It's been out over 3 years. So you put your money here, you don't really have to worry about losing your money. And JEPQ is going to be the exact same situation. But as you can see in JEPQ, we need slightly less money. You need $282,000 right now, today, at the current trading price, in order to get $2,000 per month. So all of these are pretty big numbers, right? 300,000, 280, 200,000. We need a lot of money, but these are tried and true and tested over a period of time, and we know that they work. So let's look at some new ones now. Let me close this, and I'll bring up some new ones for you. So here, let's have a look at Defiance. So if you check these out, these are the new Defiance funds that are paying super high yields. They're paying like, I think JEP, I would look at it in a minute. Let's just check it out. But QQQY, you can see here for $2,000 per month, we only need 3,000 shares. And at the current trading price, if you were to go all in today to get your $2,000 a month, it's going to cost you about $51,000. So it's a lot less money, right? It's a lot less money. It's a quarter of the amount of money for than QYOD cost. So $51,000 is not much. And if you look down here at JEPY, this one, we need slightly more shares, 4,000 shares, and we need about let's just call it $68,000 in capital to buy it at the current price today. So again, still a lot less money to get the $2,000. And if you go down and check out IWMY, which tracks the Russell, I'm not going to get into all these funds, the details on exactly what they do and how they operate, because there's so many channels who do that, and there's no need for me to tell y'all the same thing they're telling y'all. But you can check out more information on these if you like. But this one, we only need 2,000 shares. And at the current price, we only need $33,000 to get the $2,000 per month income. So that's all fine and dandy and great. But when it comes to these Defiance funds, so far, they're not performing great. There is some NAV erosion, which means the price is going down. And that's because the dividend yield is so high. So actually, in order to get your $2,000 per month, right, if you take all the dividends out of this, you're going to see your initial capital start to wither away. You're going to start to lose some money. So, you will have to reinvest at least some of the dividends. I'm not sure how much yet. Maybe 50%, maybe more, maybe less. But you're going to have to reinvest some of the dividends back into it in order to keep the NAV stable, so you don't, your capital don't erode, right? So you don't lose all your initial investment. So that is the downside to these. But as I mentioned in my previous video, the yield is very high on these. For example, like it's over like 50%, right? So all you need to do is say you have just for example, say you have a 50% yield, you hold it for 2 years, you've gotten 100% of your money back. And now you're playing with house money. You've already got your money back, and now you own the asset, and it still pays you. So these are great funds to keep for that purpose of, just basically playing with house money once you get all your money back. But for right now, the NAV does have erosion, but it's not like terrible, but it does erode. So you can't rely on these to be able to support your lifestyle abroad if you're just taking money out and not putting money back in. So maybe in the future they'll figure out, just like how QYOD did also. QYOD was also having some NAV erosion, and then I guess they figured out and turned it around, because now, as you just saw, they're performing, positively. So maybe they'll get this turned around, and I think they will, but they need some time because these are all brand new to the market, so they're going to need some time to sort out the bugs in these. But you know, now that's those. Now there are some new ones out also, like SPYI. It's been out for like a year now. They're performing really great. They opened another one, the same company, QQQI, which is also brand new, and it's performing similar to SPYI. And that one, it's like over a 12% yield or something like that, about a 12% yield. It's performing really great, but they're not tried and true, have been on the market long enough to know for sure what they're going to do. So it's hard to rely on those because we don't know how they're going to perform yet. And there's some others out there as well, such as some new ones that just got released: the GPIQ and GPIX, GPIX, which are doing the same thing as like JEPI and JEPQ, but they're investing in the entire market, not just some of the stocks from the market. But they're performing really well also. But there's no track record. We don't know the risk of investing in those just yet. So, do I think they're good investments? I do think they are, but I wouldn't be willing to go all in on them with, $200,000 capital, and then watch what happens and guess what happens to your money, right? Like, it's a little bit risky in my opinion, because I'm not a rich dude, and if I had $200,000 and that's all I have, I can't just put that into one thing and hope for the best, right? I want to put it in something that I know is 100% tested and it's going to work. So the reason why I'm using the funds like I mentioned before, QQQY, JEPY, those funds, I'm using those right now myself because I know I'm going to get my money back and I'm still working, right? If I wasn't working, I would definitely be putting my money somewhere else, which I'm starting to do that now actually. I'm going to be taking my dividends from these QQQY, JEPY, those things, and put them into these other ones that are more stable and that they're actually increasing in price. So I get the dividends and my capital increases. That's what I want in the long run. So I'm taking those high-paying dividends and putting it into those other places with the stable NAV. And so now it's time for the final little secret thing that I figured out. So when it comes to this high yield investing, I've found that in order to avoid the capital erosion, right? It's all based on the percentage of the dividend. So like some of these that have a really high dividend percentage, you see their capital eroding. But I found that if it's about a 15% dividend or less, then your capital won't erode. Most of those funds that are paying the 15% dividends, like your s.v.o.l. Or if it's less than 15%, right? Like the JEPI, JEPQ, QILD, the SPYI fits in this category as well. QQQI fits in this category, even though it's a new one. But if they're paying around 15% or less, the capital doesn't erode. So once you get over 15%, then that means you're going to need to start reinvesting your dividends in order to keep your capital from eroding, which means you're going to have less money once you start reinvesting the dividends. You have less money to spend, right? So here you go. You can see the chart here. So if our portfolio has a 5% yield, we need almost $500,000. Now, if our portfolio has a 7.5% yield, you can just base this on your entire portfolio. You can put 2 or 3 together, 4 or 5 together, and as long as your yield is around this part, you're probably going to be safe in terms of protecting your capital. So 7.5%, we're going to need $320,000. If our portfolio has a 10% yield, we only need $240,000. And if we have the 12.5% yield, something like your SPYI, then we're looking at $192,000 only. And if you have something like a 15% yield, we're talking about something like the s.v.o.l., right? S.V.O.L. It's also appreciating in capital. It's been out for like a year or so now. It's showing price appreciation, big dividends. It's like 15-16% yield. This fits right there in that category. Only need $160,000. So me personally, would I put this much money into one particular stock to be able to get my $2,000 per month? No, I wouldn't put all my money into one thing like that. Even though I know they say like it's diversified because it is an index, but like when you're putting all your money into one thing only, and that's all the money you have, for me, I don't feel safe doing that, so I will spread it out between several of these different ones, just because I know that I have some other diversification there. For example, I would put some in the S&P funds like the JEPY or the JEPY or SPYI. I would put some in the NASDAQ funds because they're a different index, right? The NASDAQ and S&P are two different indexes, so they're going to perform slightly different. The Russell's going to perform different. They're all going to perform differently. So I would spread my money out between the different indexes instead of just putting it all onto one thing. So that's how I would approach it. But as you can see here, 15% yield or less, you're pretty much good to pull all your dividends out and live off of them. When you get above 15%, that's when you come into the have to reinvest territory, or your capital starts to erode territory. So that's what I learned on this research journey. I hope that helpful for you. And like, comment, subscribe. I'd love to hear your thoughts and opinions on this topic or this video. And I'll see y'all on the next one. Thank you.